just happened was not a normal pullback. Silver didn't cool off. It was ripped lower in a single violent sequence from the high 80s into the mid 70s while most people were asleep. Tens of thousands of leveraged positions were erased in hours. Screens froze, stops slipped, margin calls didn't negotiate. This wasn't confusion, it was a forced reset. And if you're watching this, you need to understand exactly why it happened, because the next move will not be kind to anyone who still thinks feelings are a strategy. You're here with us. This is a direct breakdown of what actually happened, how the mechanism works, and why this event tells you far more about the future than the red candle itself. No noise, no drama, just structure. Let's say the part most people avoid. Markets don't reward effort, they reward positioning. When price snaps like that, it's not random, it's not bad luck. It's the system doing exactly what it was designed to do. Locate weak leverage, locate impatient capital, remove it. Fast. The scary part is not the drop. The scary part is what the drop exposed. It showed how crowded the trade was. It showed how many people were involved without a plan. And it showed how quickly confidence turns into supply when pressure is applied. Here's the fact. Price fell hard, fast, and without mercy. Here's the interpretation. The move was engineered to force decisions under stress because stress creates mistakes and mistakes create liquidity. That's not a theory. That's how modern markets function. In a calm, balanced market, a move like that would have unfolded slowly. A drift, a grind. This wasn't that. This was a trapdoor. And trapdoors don't open unless leverage is stacked on top of leverage. Leverage is what turns a normal retracement into a guillotine. You think you're trading price, but you're actually trading time. And the market charges interest in panic. Somewhere during that drop, someone refreshed their account and saw a margin warning. Somewhere else, someone thought, just a little more, it'll bounce. And somewhere else, very quiet, someone looked at the same candle and said, good. Not because they enjoy pain, but because they understand what liquidation really is. A liquidation event is the market delivering one message. Your structure wasn't strong enough. If that makes you angry, that's fine. Anger means you care. But don't aim that anger at the chart. Aim it at building a framework that doesn't collapse when volatility shows up. Because the most expensive mistake people make is confusing volatility with being wrong. Volatility is not a verdict. Volatility is a test. It tests position size. It tests time horizon. It tests how badly you need to be right now. And the market loves one kind of participant above all others, the one who needs certainty. Because certainty is expensive and the market sells it at the worst possible moment. So what actually happened under the surface? A cascade. Not one sell button. Tens of thousands. Leverage created the cliff. Liquidations created the waterfall. And the waterfall created the headline. Most people only see the headline. We look at the plumbing. During a liquidation wave, price is not discovering value. It's hunting collateral. Think of the market like a dam. When leverage builds behind it, everything looks calm. Smooth candles, predictable moves. Then one crack forms and the water doesn't flow. It explodes. That explosion is forced market orders hitting a thin book. That's why it feels like gravity suddenly turns on. That's why slippage appears. That's why stops don't behave the way people expect. So when you hear that price fell because sellers were stronger, be careful. Sometimes the seller is just an automated system closing positions because margin ran out. That distinction matters because forced selling ends, fear selling lingers. If you can tell the difference, you stop becoming exit liquidity. Let's pause for a moment. If a single overnight move can liquidate tens of thousands of traders, what does that tell you about how crowded the positioning was? What does it tell you about how many people were operating without a buffer? And what do you think happens if the next move goes the other way? That's the part nobody wants to talk about. Liquidations don't just destroy. They reset. They remove fuel. They clear the order book. They create the conditions for violent reversals. Not guaranteed, not promised, but possible. And smart participants don't bet their future on predictions. They build positions that survive multiple paths. This isn't about being bullish or bearish. This is about durability. Here's the uncomfortable truth. Chaos is where fortunes are built, not in comfort, not in smooth charts, in chaos. Why? Because chaos is when people sell for emotional reasons. They sell to feel safe. They sell to stop pain. They sell because discomfort gets louder than their plan. And when they sell, someone buys. Always. Not because they're braver, because they're prepared. They have cash. They have time. They have rules. So when you see a crash, don't just watch the red. Ask the better question. Who needed to sell? Who was forced? Who got pushed out? Because forced selling is opportunity, even though it never looks like it in the moment. Here's the contradiction that confuses people. The moments that feel worse to buy are often the only moments that pay a premium for courage. Not every drop. Not blindly. but the moments where quality and junk get dumped together because nobody has the luxury of discrimination. That's where positioning matters. And positioning is everything. Now, we hit a truth that doesn't care about feelings. Leverage doesn't just multiply returns, it multiplies personality. If you're reckless, leverage makes you destructive. If you're disciplined, leverage makes you dangerous in the right way. It amplifies what's already inside you. Ego gets louder. Fear gets faster. Patience disappears. And the market is ruthless about one thing: exposure. If you're overexposed, you don't own your trade. Your trade owns you. You wake up, and your emotional state depends on a candle. That's not strategy. That's captivity. And markets don't negotiate with captives. They liquidate them. So ask the question most people avoid. Were those liquidated accounts unlucky, or were they unprepared? The price moved. Their sizing made it fatal. That's the difference. The move didn't need to be massive. It only needed to be bigger than their margin. And margin is a razor. It feels powerful until it cuts. Here's something crucial. The market doesn't need to know your name. It only needs to know where pain clusters. People use similar leverage, similar stops, similar levels. So when a move starts, it doesn't hit one person. It hits a crowd. And when a crowd is hit, momentum feeds on itself. That's why you can't build a future on borrowed confidence, borrowed money, or borrowed time. You build it on skill, on reserves, on self-control. This isn't motivation, it's math. Now let's separate gamblers from builders. Wealth is not created by prediction. It's created by positioning. Prediction is exciting. Positioning is boring. Prediction asks where price will be tomorrow. Positioning asks what happens if I'm wrong. Prediction wants applause. Positioning wants survival. Cash is a position. Time is a position. Emotional control is a position. Knowledge is a position. And the most underrated position of all is humility. Humility is what lets you reduce risk before the market does it for you. Most people prepare only for good weather. They size up when charts feel safe. They feel confident when everyone else feels confident. Then volatility arrives, and they discover they built their structure out of paper. We don't do that. We prepare for storms. We build rules while calm, so we don't invent rules while bleeding. Because in fear, your brain isn't analytical. It's animal, and animals run. That's why systems matter, not vibes, not hope. Systems. The market is not a slot machine. Pulling the lever for excitement is expensive. Real wealth is built from a long chain of good decisions nobody posts screenshots of. It's knowing when doing nothing is the correct action. It's waiting while others exhaust themselves. And when the moment comes, acting with precision, not panic. So what do we do with an event like this? We don't chase. We don't revenge trade. We don't make life decisions on a 5-minute chart. We zoom out. We ask the question that actually matters. Is the market paying for growth or paying for safety? During liquidation events, the market temporarily overpays for safety. People sell anything liquid. Quality doesn't matter. Only escape does. That's why strong assets fall with weak ones. And that's where opportunity hides, but only for those who still have capital. Risk comes before reward. Always. Now let's talk psychology, because this is where accounts really die. The chart is not the weapon. Your mind is. Nobody needs to lie to you. They just need you to feel. They need the drop to feel personal, like a judgment. If you take that bait, you'll do exactly what the system needs. You'll sell at the wrong moment. You'll swear off the market. You'll exit right as conditions reset. Discipline isn't strength, it's predecision. A boundary you don't negotiate with in stress. Here's a simple framework. Define the tool in one line. Explain why it matters in one line. Apply it in 2. Leverage is borrowed exposure to amplify a bet. It matters because it makes small moves lethal. In this event, leverage triggered forced selling, which magnified the move. Positioning is the mix of cash, time, knowledge, and emotional control. It matters because it determines whether volatility is an opportunity or an extinction event. Same candle, different outcomes. This isn't really about silver. Silver is the stage. The script is human behavior. Life follows the same pattern. Overextend, and one shock wipes you out. Build with buffers, and shocks become survivable. Structure protects portfolios and futures the same way. Another truth most people miss. Wealth transfer doesn't happen because winners are smarter. It happens because they're structured. They can be wrong longer than others can stay solvent. That's the game. If we want to win, we don't need to be right. We need to stay alive. Stop living on the edge of margin. Stop living one headline away from panic. Panic is expensive. Here's a question that should make you uncomfortable. If you were leveraged during that move, what would your outcome have been? Be honest. Now ask another. Without leverage, would that same move feel catastrophic, or would it feel interesting? Your answer tells you your real position. The quiet winners did 3 things. They sized so volatility couldn't kill them. They held cash. They followed rules. No secret indicators, no insider whispers. Structure. So here's what we do going forward. We build long-term systems. We respect risk more than reward. We keep dry powder. We slow down when fear spikes. We double check ourselves when confidence spikes. We don't gamble. We measure. Markets punish people twice. First with the drop, then by convincing them to sell, and they move without them. That's not personal, it's mechanical. So decide now, are you here for excitement or outcomes? Outcomes require process. Process leads to compounding. You don't win with one trade. You win by staying long enough for math to work. If you felt forced to sell, that's not shame, that's data. Use it. Audit where you relied on hope, where you relied on borrowed exposure, then rebuild. During drops, crowds see disaster, builders see inventory. Same event, different lens. That's why we think differently here. If this breakdown is helping you, subscribe. We focus on structure, not hype. And if you want this thinking to reach people before the next liquidation wave, hit like. Simple and effective. Now answer this honestly in the comments. When that move hit, did you feel fear or did you feel curiosity? And if you were leveraged, did you actually learn the lesson? Because the market doesn't care about intentions, only exposure. This wasn't the end of anything. It was a message. Liquidity is thin. Leverage is crowded. The next major move will be faster. Survive first, then swing. The next candle is already loading.